Hello, welcome back to Reflections on Investing with the Cornell Capital Group. And this week we're going to follow up on what we started last week. Recall last week we talked about how much the S&P had run up since January of 2019. And we focused on earnings. We said that earnings had risen sharply, but that increase was in large part due to low interest rates and low taxes, and that both those engines had run their course. And in fact, some of them, like taxes, and for that matter, interest rates, may even reverse directions. But we didn't tie it all together. We just looked at earnings. So let's go back to the index and tie it all together by bringing in the multiple. So if we go over to the computer, here we have the S&P 500 index. That's what happened from January of 19 to the present being September 18th, 2024. It started at 2506, ended at 5713, an increase of 128%. So that increase has to be due to a combination of two things: a rise in the earnings and an increase in the number of dollars that investors would pay for each dollar of earnings, which is the PE multiple. So let's look at the pieces. First, earnings. This is the earnings on the S&P 500. Started at about 137 and rose to 206. That's an increase of 54%. So the engine that we were talking about last week accounted for a rise in the index of 54%, but it rose 128%. So during this period, investors must have been willing to pay more and more for each dollar of earnings, and that's the PE ratio. So here's the PE. It started at about 18.5. And over the period, it rose to 27.7, an increase of 48%. If you take that 48% and compound it with a 54% earnings increase, you get the 128% increase in the S&P 500. Now, if we're going to continue to have outsized increases in the index, it's got to come either from earnings or from the multiple. And last time we said we felt the dramatic increase in earnings based on interest and taxes had largely run its course. Well, what about the PE ratio? Can that continue to expand and thereby increase the index? Well, the PE ratio depends primarily on two key things: expected future growth in earnings, which we've already said we believe has plateaued. So on that basis, the PE ratio might even decline. Earnings growth expectations could fall slightly. But there's another aspect to the determination of the PE ratio, and it's the so-called equity risk premium. It's how much investors require over the yield on treasury bonds to hold stocks. And the more that investors are willing to hold stocks for low equity risk premiums, the larger the PE ratio. So what's happened to this equity risk premium? Well, it's a little bit hard to measure, so I'm going to give you the estimate provided by Starmine, which is a subsidiary of Refinitiv, a database owned by the London Stock Exchange. But if I used a different measure of the equity risk premium, such as that calculated by my colleague, Professor Aswath, it would look about the same. Here's the equity risk premium, estimated by Starmine over the period. Starts about 6.25, stays there for a while, but ends at 3.76. Not much of a premium over bonds, down 40% during the period. Well, now that you know all the pieces, you can ask yourself, if I think that stocks are going to continue to offer superior future returns, what's the driving force going to be? Is it going to be earnings, or is it going to be the multiple? And in our analysis here at the Cornell Capital Group, we don't see it being much of either. In other words, we feel that going forward, earnings growth will be slower and the PE multiple will remain constant or even decline. That's why, at this point in time, we're taking a very conservative stance. You may disagree, but if you do, you should go back to the underpinnings, earnings, and multiples and decide which one you think is going to drive the market higher in the future. This has been Reflections on Investing with the Cornell Capital Group. Thanks.